open discussion. So Jake's going to have his talk, but if there are questions at all at any point in time during the presentation, at the bottom of your screen, you'll see a Q&A section. So just type in your question and I'll make sure that that's addressed by Jake at the appropriate time. So feel free to ask as many questions. We will have a formal Q&A at the end, but if anyone has any questions about what Jake's speaking about at that particular moment, make sure you just enter that in the Q&A. We'll make sure that's addressed. Back to you, Elaine.
And for those of you who are watching the replay and you're not watching this live, then be sure to reach out to us or Jake directly. All of our contact details will be available at the end. We'll be happy to answer your questions afterwards if you are not joining us live and you're watching the replay. And because the webinar is being recorded, so it'll be available on all of our platforms, our website, within the next 48 hours or so. And I think that's all. I think that's all the logistics. So I'm going to turn it over to Jake. I'm going to activate Jake and make sure that he, oh, there you are. All right.
Everybody.
Okay, so.
Alex and Elaine, thank you guys a lot for having me. As promised, I did a little COVID shave of my head today. So this is a new look. Not sure if you're used to this, but there it is. So today I just wanted to give everybody a bit of a quick market update on what I'm seeing. First, who am I? So I'm Jake Abramowicz. I'm an agent at Mortgage Edge. I've been mortgage brokering for just about 18 years now. And I haven't seen it all, but I have seen a lot. I'm fortunate to say I do a lot of business because I love my job and it shows in the results, but I focus on client always, not results. At the end of the day, what matters to me is winning the client, not the deal. So because of my experiences, I would like to share with you some of the things that I see, some of the trends that we're seeing, some things to watch out for, whether you're a first-time buyer, whether you're an investor, whether you're a move-up buyer or seller. This is really for a broad audience because I don't want to just go after one target market. I want to tell everybody what's happening because everybody is interlinked in this ecosystem known as mortgages. So I will share my screen. Give me 1 second here because I've prepared a little bit of a slideshow. I promise it'll be fast, but very informative. One moment and click on present. Here we go. Just making sure everyone can see this. Mortgages during a pandemic. So hashtag, the more things change, the more they stay the same. And that's kind of what the topic and the theme of this message is going to be. And that is that mortgage financing has changed a little bit, which I'll get to, but the reality is things are still pretty smooth sailing moving forward. So number one, I am a voracious reader of the headlines. I read the Globe, the Star, the Financial Post, the Economist, Wall Street Journal, New York Times, almost on a daily basis. As much information as I can get, I try to get in, take in, and filter out to my readers of my blog. So the headlines are definitely scary right now. So the other day, CMHC predicted that prices will fall between 9 to 18%. TD thought, well, maybe they'll rise by 7%. This was predicted a week before that. RBC today, the CEO of RBC, Dave McKay, said they don't expect, or it doesn't expect a lot of up and down moving forward. Things will remain flat. CIBC, Benjamin Tal, not really clear on what he's thinking yet. He's all kind of wait and see approach. BMO recently said 5% down. So what does it all mean? What does it mean to you, the reader? What does it mean to you, the homeowner? What does it mean to you, the financer, the investor, et cetera? Well, to me, we have to dig deeper behind the headlines. So although the headlines are quite scary right now, when you look at CMHC's comment of 9 to 18% fall, first of all, that's Canada-wide. That's not Toronto, that's not 416, that's not 905, it's not Bathurst and St. Clair, it's not micro, it's very macro. And even the president of CMHC who said this comment himself mentioned that this is a best guess. Now, it is true CMHC sits on a mountain of information, but they mostly discuss Canada, not specifically Toronto in that, or 416 and 905 in that comment. So we have to be very clear in hey, the headline is telling me that prices are going to fall, but that might be Canada. That might be Vancouver, it might be Calgary, maybe Toronto, maybe Montreal. Let's dig deeper and see what kind of asset class am I owning? What kind of asset class am I looking at buying? And what is most likely to keep rising, falling, or going flat? So Elaine and Alex and I, we always talk about this, and we always look past the headlines. And that's what I want to tell all of you. Because if you read something in the newspaper, ask me. I'll tell you what I truly think. If it's bang on, I'll tell you, look, TD's bang on, or Royal Bank is really right. If it's a little bit erroneous, it's just meant to sell the headlines, I'll tell you what I think. And frankly, I think this week and last week was a really good headline selling news week, but it wasn't really accurate in my opinion. And what I mean by that is, one other thing that Evan Sedal, who's the CEO of CMHC, mentioned was, watch out for the deferral cliff. Now, anybody who's everybody knows what a cliff is. It's somewhere where we don't want to fall over or we may die. Well, Evan mentioned that after the mortgage deferral program finishes, which will be somewhere October, November, there will be a huge cliff of people who suddenly will fall into arrears. The truth is that right now we are seeing 99.6% of all mortgages not in arrears, not in default. 99.6% of all mortgages are paid on time. What Evan meant to say was, we are going to see requests for further deferrals. So he predicts 20% of all mortgages in Canada will need to be deferred further. What he said was arrears. And so of course that got everybody thinking, holy crap, 20% of mortgages will be in default. Wow, we're going to see power of sales for every fifth home. Absolutely not true. Royal Bank themselves, Canada's largest bank and largest lender, and they also have a mountain of evidence. They said we are going to see approximately a 99.2% payment on time rate, or 0.8% arrears rate from a 0.4% arrears rate during and after the pandemic. Now, nobody knows who's right. Could be Royal Bank, could be CMHC, could be somewhere in the middle. But to say that 20% of all mortgages will be late, frankly speaking, I think is a little bit irresponsible. And I'll get to the government's role in our market in a minute. But I just want to tell everybody, guys, read the headlines. They're scary. Read deeper and ask us. And we'll tell you what we think, because some of this is designed just to sell press and some of it is designed to spread news, right? So when I said at the beginning that the more things change, the more they stay the same, I meant that business is truly 95% usual. Things are not changing. Banks are lending. Banks are very liquid. And a lot of that has to do with a huge, huge intervention by the government of Canada, where they purchased upwards of $150 billion in mortgage assets, which was a massive liquidity relief. Appraisers are absolutely appraising property. They're modifying how they're appraising property. They're not visiting you in the home. They're driving by. They're asking for pictures and photographs, but they are still having appraisals being done. And guess what? The last 50 files I've done since the pandemic has started, one did not hit appraisal. And that one was a private sale where a buyer, quite frankly, went crazy and had to have the house. Now, that's not to say that 99.9% of all appraisals moving forward will appraise on time. But if we're smart and careful of how we approach your deal, whether it's a purchase, a sale, a refinance, etc., we can handle the appraisal process and we can set your expectation. Third, lawyers are closing. Finally, the banks and the lenders have adopted their policy where they are now allowing for virtual signing, because as you can imagine, the legal side of the transaction is the most important. That's where title is registered. That's where ownership is verified, title ID, etc. And so prior to this, lenders were very, very scared of having lawyers sign virtually, but now they are totally okay with it. Nothing has really changed except for the process. Now, what does that mean, the process? The process of getting a mortgage is a little bit different. Whereas 3 months ago, if you called me and said, Jake, I got your name from Alex and Elaine, I'm looking at buying a property. What do you need from me? Well, we have a quick conversation, and usually within the first 10, 15 minutes, I can tell you what you're qualified for within a 99% variance. What happens now is I have to vet all of your income and down payment documentation. And I'm vetting your income documentation because I need to make sure 100% you're employed, there will be no COVID effects. And I need to verify your down payment verification, because I need to make sure if you are employed, you're not getting CERB. A couple of clients in my sphere, in my network, have been caught receiving CERB while receiving full-time payroll. And guess what? Their mortgages were canceled. Now, that wasn't my client, but I've seen that happen. So I just got to make sure. So the process is a little bit more arduous at the beginning, but guess what? That means we've done all the heavy lifting at the beginning. Your mortgage is approved, unconditional. The lender will not come back to you and ask for more documents because they have signed off on all income, all that payment up front. So if you're willing to work with it, and you're willing to work with my process, it's very easy. It's all virtual, all online. I keep telling people I kind of pioneered the working from home thing because I've been doing this for quite a number of years now. Our process is all virtual, all online. I just require more docs up front so that we know what we have moving forward. Just wondering if anybody has any questions, go into the Q&A. Alex, Elaine, if anything pops up, anything I may have missed that you'd like me to say, by all means, let me or chime in.
For sure, Jake. Yeah, I'll pause. Once we have a question, we'll let you go, but just keep talking. This is very, very informative.
Cool. So in the prior slide, I was saying 95% of things are the same, which is true. Now, we're in a pandemic. Guess what? The lenders will tighten up a little bit. So Alex today and I were mentioning, we were discussing this presentation, and he brought up a few very good points, which the changes that are happening are aimed at investors, are aimed at borrowers who currently have lines of credit or may want them, and really aimed at self-employed borrowers. So let me quickly go over these three in case you, the reader, the listener, are one of these. So whereas prior to the pandemic, if you owned a property, call it $1 million Midtown Toronto duplex or a single family dwelling, and you had a mortgage of $500K, and you wanted to get into the investments, you wanted to buy a condo to rent out, prior to the changes, you were able to use your line of credit and put that as a down payment towards your investment property. A couple of lenders have changed that policy. But guess what? They have only changed the policy where they won't let you do both deals. They won't let you do the line of credit and the purchase on the investment piece. Okay, fine. So we go to Bank A and get the line of credit, and we go to Bank B and get the condo or the next purchase that you're looking at doing. And just to be very clear, this is aimed strictly at current times. This is not a change that we are expecting will continue, unless, of course, the bank's risk policy meets the necessity and says, you know what, we do expect this to continue moving forward. But the lenders that I've talked to that have made this change have said, this is only for now. The lenders have also cut back a little bit on the max number of properties that they will finance. So again, if I go to Bank A and I do 3 condos with Bank A, and I'm capped out at 3 condos or 3 properties, I go to Bank B. They may allow 2 condos or 2 properties under their portfolio, etc. Whereas allowing 3 with the other lender. The flexibility of being a broker, and I don't mean to toot our own horn, but we do offer a lot of value, is we go to these 10 to 12 different lenders out there. Number 2, one of the biggest headlines a couple of weeks ago, if you read the report on business, one of my colleagues there, Rob Carrick, wrote, home equity lines are changing. If you have one, be careful, cash it out. They're in the crosshairs, all of these crazy, scary headlines. Well, the lenders are absolutely not cutting back on home equity lines of credit for 99% of people. And what do I mean by that? If you have a mortgage with a HELOC, home equity line of credit, as long as you make your payments on time, as long as you have good credit, as long as you're not late on your mortgage, as long as you're not over leveraged, believe me, the lenders are checking in on their data, but you are the last person they're going to go after. The first person they're going to go after is the person who late on the mortgage, late on the HELOC, over leveraged to 100%, property values have dropped, employment is an issue, in a hot spot where employment is an issue, et cetera, et cetera. So I want everybody to know, if you have a HELOC and you want to convert it to cash and buy a GIC, hey, listen, I can't stop you, but I don't think that's a really right strategy, because I think the bank is going to give you enough heads up and warning for you to do that. So I'm not really worried. I'm not expecting any wholesale changes. The third type of change that we are seeing pretty heavily is the self-employed borrower, because as you know, the economy shut down. And if you are self-employed, a lot of lenders look at your past 2-year history, and that's how they have so far qualified you. But if you're working in a field where you were part of the shutdown, it is really hard for me to convince a lender today that even though borrower X works as a carpenter or works as a massage therapist, well, that business is shut down. It is hard for me to get you a mortgage currently. And if you are getting CERB again, it is very hard for us to get that done unless you're willing to work with an alternative lender, which there are plenty of. So there are some changes. I don't want to say everything is the same, but if I look at the big picture and I talk to 100 people, I'll tell you that 95 of them will still qualify for a mortgage, whether they choose to take one or not is their call. And 5 of them are not seeing any appetite or not seeing a possibility at this time. So things are almost business as usual.
Jake, it's Elaine.
Elaine?
I just have a quick question about the self-employed bit that you just discussed. So you're talking about right now, you know, there might be teeny tiny bit changes, but going forward, when you're looking 2 years back, many people might have a blip in their income this year. So how do you think banks will adjust for that going forward?
So when I've spoken to my lenders, and that includes TD, Scotia, Manulife, Merix, Meridian, Duca, you know, lenders across the board, that is one of our number one questions. What a lender will do is they will look back 3 years. And if 2020 was a blip where, say 2018, you made 90,000 gross, 60,000 net. 2020, you made 100,000 gross, 80,000 net. And 2018, 2019, you grew. And 2020, you were on pace to do well. And you had a 3-month lull. The lenders are saying that they're willing to look at it on a case-by-case basis, but they're willing to prorate the income, where they're going to say, okay, we understand 2020 was a really tough year. How was your 18 and 19? And how is your 21 year to date? So there is going to be some flexibility, because you're absolutely right. We are going to see a lot of blips, but that's exactly what they are, is blips. And if a lender sees a continuity of income from those self-employed borrowers that was only affected because of COVID, and then once COVID has been lifted, once phase 1, 2, and 3 have been lifted, we are now back to full steam ahead. The lender will make the case where that deal has to be approved. Now, I want to say really quickly, I do a ton of self-employed financing. There are 3 ways of qualifying for being a self-employed borrower, and it depends on which bucket you'll fall under. And frankly, I think that a lot of our readers and listeners will reach out to me and we'll discuss your specific case, because each case can be different.
Okay, great. Thank you.
No problem. So earlier I mentioned that the government is wanting to make some changes and interventions. And this headline is called, "Why the Government is Crazy." So let me explain. Sorry, I moved that one part ahead. I don't know why the content's not here, but let me explain what happened on Monday last week. Evan Siddall got in front of a finance committee and said, we need to help ourselves from ourselves. We need to make it harder yet again to get a mortgage. And one way that is now potentially happening is we may see the elimination of the 5% down rule. So just to be very clear, for those who are current owners and have owned for a very long time, you can still buy a condo or a house with 5% down, as long as the value is $500K or less. And you can still buy a place for up to $999 with 7.5% down. So there's a bit of a sliding scale moving up. Well, Evan Siddall is saying, and CMHC, remember, this is the head of CMHC who decides these rules. He's saying, we want to scale that back to 10%. And I think that is absolutely the worst timing. Because if we are truly going to see a market that will move sideways, if not maybe down, as he has maybe predicted, isn't now the time to let borrowers, especially the first timers, get in that market? Because CMHC has always said, we want 100% Canadian home ownership. Well, the time for people to buy is when the prices are low. Otherwise, it's really hard to buy when the prices get higher and higher. The time to people get in is when prices come down a little bit. And now eliminating that 5% down borrower will also have a cascading effect. So if you're a listener, if you're a watcher here, and you're a first-time buyer and you have 5% down, and you don't think you can save up to 10% or get help from mom and dad, etc., we need to get you in this market before the government makes this change. I expect this change to happen by the end of the year. And if you're a seller and you're looking at selling one of your homes or a home that would be very attractive to a starter buyer, to a 5% down buyer, we need to get you out of that asset class ASAP and move you up the ladder. So I think personally the government, if they do make this change, is a little bit crazy. Now, since then, Evan Siddall has walked back a little and said, no, that's not really what I meant. We're all really waiting, quite frankly, on pins and needles. And I'll add this content. I'm really sorry that it hasn't populated here. I frankly don't know why, but I just don't think that the government will do the right thing by eviscerating our equity, those who own property, and by making it harder for buyers to get into property. It kind of doesn't help us at all here. So if there's any questions, Alex?
Yeah, Jake, just a quick question on that. I don't know if you have any stats, but what is for buyers that are purchasing property of 500K or less, what percentage are you seeing are putting 5% down?
So my book of business last year in 2019, I'm very happy to say that 288 deals, and roughly 21% of those buyers were 5% down buyers. I am a little bit more aggressive on the 5% rule. And I say that meaning for some reason, I attract that first time buyer more than maybe the average bank. The average is around closer to 10%. And now some of these borrowers had 10% and they chose to do 5 because they realized that they wanted to have a float. They wanted to have some cash on reserve. And listen, even at 5% down, I'll get to this in the next slide, but where rates are right now, half of your mortgage payment, half of your payment from day one goes to principal. So I encourage people, look, if you can get to 20, let's get to 20. To get to 5, to 10, to 15, let's get there. But don't stretch yourself from 5 to 10 and have nothing left in the bank because the difference in payment is very small. But Alex, it's a good question. It is a small minority of borrowers that have only quote unquote 5%, but it does represent the first time buyer that powers the move up buyer, which we need to also help out.
Yeah, there's definitely a ripple effect if this does come into play, and that's the risk in if they do institute this. But yeah, I just wanted to get a sense of what some of the averages were in the for your book or the industry in general, just so that we can understand the implications moving forward.
And I know that the 416 core is very expensive, but as you move out, you see much more and more value. And hey, one of the theses that a lot of people have is, will people start moving out of 416 into 905? I can't really get into that. I don't know yet what this work from home thing will have kind of effect, but certainly across the 416 and 905, east to west and up to the Aurora, Barrie, et cetera, there are still many opportunities at 5% down and very good opportunities. So I want them to keep the program because it helps Canadian ownership, because it's hard to get to 10% down unless they come up with some sort of incentive. That's way better than the one they created last year. So let's talk about rates. Everyone talks to me about mortgage rates, and hey, listen, it's the first thing we chat about when I talk to borrowers.
Actually, Jake,
yes.
Before you move ahead, we have a question.
Okay.
So for those who, so if someone who has a budget for over $1 million, would you recommend 20% down, and do you expect any changes on that front? Great
question. So unfortunately, the government of Canada has not recognized that the city of Toronto, specifically 416 and some parts of 905, and Vancouver are more expensive than the average city in many places of the world. So they never increased the limit of the $1 million rule with CMHC. So right now, anything that has a 1 in front of it as a purchase price must have minimum of 20% down. Some lenders do have a sliding scale. So what that means is if you buy between $1 million and $1.5 million, you can get 80% financing. So 20% up to $1.5 million. As you cross over the $1.5 million mark, some lenders do start to scale back and lend you a little bit less. So 80% of the first $1.5 million and then 50% thereafter. That's the only potential change I see happening, is that sliding scale being enforced more. I'll tell you right now, for any deal I get $2, $3 million, which is not many, but when I do, we get a sliding scale exception quite all the time. But there are times where I'm already starting to see the lenders are a little bit wary of the luxury properties. Now, luxury to me and to you may be a different thing. When I say luxury, I mean the 2 million plus mark, where lenders might start scaling back on that. But yes, absolutely. If you're looking for $1 million plus, you need to have 20% down. There's no way around it. Back to rates for a minute, if I may. So fixed and variable, I'll talk about going fixed or variable in a minute, next few slides. But right now, the current prime rate is 2.45%, and the overnight rate is 1/4. The overnight represents what the Bank of Canada borrows at, and the prime is what they lend to the banks at. I don't know if you've heard in Europe recently, in the last few years, we have seen negative interest rates, same as in Japan. The Bank of Canada does not want to go into negative interest rate territory. Therefore, it is very likely we are not going to see lower variable rates than now. But hey, anything can happen. And the Bank of Canada is now bringing on board a new governor. Stephen Poloz is leaving, the new guy's coming in. And the new governor has said we want to maintain the same policy. So as far as we're concerned, variable will not go down much lower. But the Bank of Canada can't increase variable rate. The earliest projection, and I mean the earliest, and right now it's like throwing darts at a board, is 2022, mid to late 2022 for variable rates to start increasing. Why do variable rates go up? Variable rates go up when the economy does great, because the Bank of Canada knows people have money to spend. Well, right now, the opposite is true. So we need to have as much low rate stimulus for people to borrow and people to have free cash to spend on other things like vacations, like food, necessities, and luxuries. At the same time, fixed rates, the beginning of this year, were exceptionally low. 2.29, 2.39, then the pandemic hit, and the banks had to increase rates very dramatically, almost a full percent, to offset all the potential capital losses. And when they saw that only 15% of people deferred their mortgages, rates starting to trend back down again, and fixed rates now are in the 249, 239 category, some as high as 269. But the point I'm trying to say here is, guys, rates are going to remain low for a very long time. And as a borrower, if you're an owner currently, if you're looking to move up, or if you're a first-time buyer, this is really good. This means that so much of your principal, so much of your mortgage payment is hitting principal. And you can lock in for a 5-year term. Throughout the uncertainty of this pandemic recovery, you will have a very low rate. So rates are going to stay low, and that's one reason why I believe the market will continue to do very well. Second reason that I'm sure Elaine and Alex can agree with, supply is currently very tight. And when supply is very low, and I'm seeing a lot of demand, yesterday I had 18 phone calls for pre-approvals, I'm seeing a lot of demand percolating. So I do expect that demand to slowly start trickling back into the market. If supply remains low and rates remain this low, I do not expect any sort of major price changes moving downwards in our markets, at least 416905. So rates super low for now. If anyone has any questions on your rate, this might bring me to my next slide, which we all know breaking up is usually very hard to do. But if your mortgage rate starts with 3% or more, you got to talk. We got to talk. You got to talk to your bank. I ran a quick scenario here. Someone with a 500K mortgage at 3.19%, which was available last year with a relatively good penalty of 3 months interest, 3,600, can save $11,000 over the next 4 years net after paying the penalty. So anyone out there who has mortgage rates of 3% and more, get in touch with us. We'll help you out. We'll figure this out. We'll unlock equity. We'll maybe get into the investments. We'll do something to make sure that you're saving, and we'll make sure you're with the right lender moving forward. So that is almost everything in a nutshell. I did want to finish off with a few points here. No client is the same. We all know that, and it's the same in most world, but in my world especially, there are so many different options for you guys to take as borrowers. And all the time, or oftentimes I get, hey, how come another client, or how come my friend got this rate or that rate, or they have this and that? Let's focus on your situation, because there is no one size fits all. We all make our risk differences, risk decisions right now. And I just want to walk you through it, and I want to be as transparent as possible to help you understand the mortgage market and understand each deal is different. Let's get the one that's right for you. Second, fixed versus variable. Since I started mortgage brokering, I'll never forget my first ever client. His name was Vedat, really nice Turkish guy. And he asked me, should I go fixed or variable? And since then, I'll always tell people, I can't tell you what to do, but I can only guide you on what's happening. So right now, fixed versus variable, it's pretty easy for me to say this. Variable rates aren't rising anytime soon. If you're the kind of borrower that may be selling prior to 5 years, go variable, because your penalty will always be very low. And if you're the kind of borrower that likes to take a little bit of risk in your investments, you buy stocks rather than bonds, consider variable. If you're the kind of borrower that's not selling, not leaving anytime soon, and you would rather not look into your mortgage rate ever for the next 5 years, unless I tell you rates are too high, consider going fixed. Usually the rule of thumb is if the difference between the two rates is 75 basis points or 0.75% between the two, you always go variable. Right now, the difference is much smaller, but it still doesn't mean one is more right than the other. Now, the last thing I wanted to say, and my previous slide kind of touches on this, as much as I agree that mortgage rates are super important, I also want to put you into a mortgage where the term is equally important. I'll give you a quick anecdote. A client reached out to me because they found me on Twitter, and they saw that rates, if you're over 3%, you should break right now. Well, his rate was 319, 700K mortgage with HSBC. At the time, at a great rate, 319. This was last year. His penalty is $38,000 to break versus what it could have been closer to $5,400 if we paid a little bit tiny more on that mortgage rate. So I just want to say mortgage rate's important. I'll try to give you the best rate, absolutely, but I ultimately want to give you the absolute best deal I can. That's it for me. I'm Mortgage Jake. Anyone on here can find me anytime. You can text me, you can call me, 416-910-4448. You can email me. I work with a full-time assistant. It's just me in Dallas. We're always available. I'm all over Facebook, Instagram, Twitter. You can find me anywhere. If you have any questions, I'd love to help you out. Thank you, Elaine and Alex. I really, really appreciate you guys putting this together and giving me a chance to speak to your loyal listeners and followers and readers. And if anybody has any questions, shoot them my way and we'll chat.
Thank you, Jake. That was very, very informative. And I know I really enjoyed it. I know our clients also enjoyed it and got a lot of value out of that. I do have a question on mortgage deferrals. Mm-hmm. Is there a negative impact if you have a mortgage deferral, and does it go on your credit score?
Great question. So all of the lenders and banks have clearly said that they do not and will not give you an M2 rating as long as you have agreed to a mortgage deferral program with your bank or your lender. Now, what's an M2? An M2 is you are late 2 months on your Equifax score. If I see an M2 prior to the pandemic, it's a really big problem. So they've all made it very clear, we will not give you that rating as long as we have that agreement. That's not to say you, the borrower, shouldn't make 1,000% sure that's in writing. If you reach out to Royal Bank, CIBC, anybody, and they say, yeah, don't worry, Alex, we've got you deferred, get that in writing. Just put it into an email. It doesn't hurt. Because if something ever happened in the future, I can easily fight that. We can go to Equifax. I'm a power user of Equifax. We can go to that bank and we can go to them and say, hey, you agreed to this. You've made a mistake. Let's fix the mistake. The second part of your question is, should I defer my mortgage? At the beginning, I was telling a lot of my clients, look, from a cash flow perspective, if you are not working, absolutely defer it. Currently, there will be no real impacts from you other than the fact that you will have to make that payment up in the future. But this goes again to the point where I say it depends on you, the client. When is your maturity date? How much term do you have left? Some of the banks have said if you defer, your payments after deferral will have to be built in with the deferral amount. So if you've only got 6 months left, you might be seeing much higher payments than if you got 4.5 years left on your mortgage. So it depends on cash flow and cash flow only. With the fact that rates aren't changing anywhere, that's great. That means that you're not losing any potential gains in very low rate environments. So from a rate perspective, there is no impact. From a payment perspective, there may be. From a credit perspective, get it in writing.
I have something else to bring up too, Jake. I follow you on Instagram, and I think that at one point you had mentioned that pre-approvals were going through the roof. Like it was keeping you super busy. So why do you feel that is happening, and how do you think that that's going to impact real estate?
Great question. The reason that this is happening is there are a lot of people that are out there on the sidelines that are waiting for a correction. So Warren Buffett says it best: try to time the market and it'll be nearly impossible. Buy on fear, sell on greed, etc. But there are a lot of people that have been waiting for an opportunity to enter the market. They're not necessarily waiting for a correction. They're hoping for it to happen. They just want a chance to get in. And they want maybe more of a loosening or a more comfortable process. I mean, Elaine, Alex, and us, we've seen multiple offers like crazy. They want situations where maybe there won't be a multiple offer. Maybe there will just be one, maybe a conditional period. So what happened during the pandemic, as soon as it hit, my phone started ringing off the hook. People are saying, hey, I see this as a great opportunity to be ready in case. And a lot of those buyers are just simply waiting on the sidelines, ready in case. In case of what? In case an opportunity that they find value presents itself. And that to me is a very healthy indication, because if you look at the numbers of people that are unemployed, very unfortunately, we're at about 15 to 18%. But if you look at the number of people per job category, per income, et cetera, the majority of borrowers in Toronto are still employed. So, and I believe the City of Toronto stat employment rate was closer to 93% of people are still employed. So remember, unemployment tracks all of Canada, east to west. So the borrowers that were asking for a pre-approval and still are the ones that want to be ready in case an opportunity presents itself. So your seller may be that opportunity. And that's the time to get them from that property to a bigger property, to a downsize, whatever the situation is, and get that first-time buyer into that home. So pre-approval, it takes 15 minutes. We do it online. We make sure you're ready to go. And as soon as I say you are ready, you can buy right now, off we go and start looking.
Great. Okay, Alex, do you have any questions or anything?
Yeah, I have a question regarding mortgage renewals. So one of the questions that I often get, even as a real estate agent, is, oh, my mortgage is due. I just got my letter in the mail. You know, what should I do? And one of the things I always say, and I'd like to talk about a little bit more of that process, is whatever you do, don't sign that paperwork before you talk to Jake. Because often, as you know, Jake, and you can speak to that a little bit further, the rates that are offered by the banks in their mortgage renewals are nowhere near their best rates. So maybe you could talk a little bit more about that process too.
I don't know if many of you guys have heard, I hope you have, or I'm sure you have, it takes 5 times as much to get a new client as to keep an existing one. Well, unfortunately, the banks take that opportunity, and the mortgage lenders, and depending on where we are in the mortgage rate cycle, they will try to give you an early renewal 6 months before your actual renewal date, because they know most other lenders can hold rates for 4 months. Be very careful with that renewal, absolutely, because you are going to sign a document and you're going to early renew without exploring your other options. The second thing is, some banks and lenders will try to sneakily give you a renewal into a product that's very restrictive. You can't leave unless you sell. Your penalty is 3 times higher. You thought it was a variable, but it's a variable for a shorter term, etc. All it takes is literally 5 minutes for me to say, okay, what do you have? How much are you renewing? Who are you with? And what's the offer? And you know what, Alex? There's a lot of times where I say to a client, this is a really good deal. Take it. But there's a lot of times as well where a client will think, well, I'm getting 279. This sounds really good, right? Well, you could get 2.29, or you can consolidate all your debt, or you can get rid of that HELOC and put it all into one mortgage to pay that off since you've invested it, etc. A mortgage renewal is, you're a free agent. You're like a sports celebrity at this point. Anyone wants. You're a very lucrative client to take on. And the process is so easy. Renewal, tax bill, T4, pay stub, application. 5 things done, approved, we move you over. So the renewal process is easy, and it's one where I'm surprised at how many people just sign. And I see on Twitter all the people that are showing me what they're being offered by the bank, and I just think, guys, let's just talk. Let's talk for 5 minutes. Now, if you're unemployed, you can't renew, or it's an investment property, whatever the situation is, a renewal may be the best thing for you. And guess what? All it does is taking a quick signature, maybe a phone call to the renewal department trying to get a better rate. But let me navigate that for you. Let me give you what I think is the best option for you, and we'll go from there.
That's great. Thank you. Are there any other questions? Anyone have questions for Jake before we wrap up?
So if anyone's on this webinar and maybe aren't comfortable discussing your private situation, then please reach out to either us or Jake directly, and we'd be happy to help you. I'm just going to share screen right now just so that everyone has all of our contact details front and center. And yeah, I think that's it. Oops. There we go. Okay, so that's how to reach me and Alex. That's how to reach Jake. If anyone has any follow-up questions, or like I said, if you're not watching this live and you're watching the replay, please reach out to us and we'd be happy to help. So I hope this was very helpful to everyone. I mean, I learned something too, as I always do from Jake. And we look forward to seeing you on the next webinar.
Thank you, Jake.
Thank you, Alex and Elaine. I really appreciate it. And thanks, everybody. Stay safe, wash your hands, be smart, and let's get through COVID all together.
Awesome.
Take care, everyone. Bye-bye.
Great. Thank you.